Hi, it's Mark Idem from HONU Trading with the third in our series on gaps. Today we're going to cover the gap down and trap. Our disclaimer for educational purposes only, know your time frame and risk tolerance. And today I'm going to introduce a different aspect of risk management being job one, to take the trade or not take the trade. So today we're going to look at the gap down and trap. And we're going to look at a daily time frame to frame a potential trade, to ask ourselves how much risk in dollars per share. That's always your first question. Then how much potential reward, also in dollars per share. Is there enough reward to justify taking this risk? And then the third question is, if so, how many shares should I take? Risk per trade in dollars divided by risk in dollars per share on this trade. So today we're going to look at Foot Locker, and this is looking back to yesterday, May 18th at the close. And it closed around $41.50, two potential overhead resistance levels if it gaps higher, and four potential support levels if it were to gap lower, corresponding to each of the previous lows. It in fact gapped lower, and gapped strongly lower, down 26% on the day. They missed on earnings, they missed on revenues, and they gave lousy forward guidance. So if we look at potentially framing a trade, you certainly would not want to buy something that gets hammered down 24%, particularly on bad fundamental news. So if you're looking for a short sale, you don't have a lot of room between that and the last support level, which is coincidentally near a psychological round number of $30 a share. So you've got roughly 80 cents of profit to take a roughly $1.30 of risk. You're making, if you're correct, 64 cents for every dollar you put at risk. I would not take that trade no matter what. No way. So we asked the first question. My risk is dollars per share is about $1.25, $1.30. My potential reward is about 80 cents. So how many shares? That's irrelevant. You just don't take the trade. So if we look at it on an intraday basis, it gapped down and opened around 30.70. That's almost $11 lower than the close. Trades a little bit higher, goes up to the high of the day, comes back down. Even if you did take that trade, yeah, it worked, but that is a lousy risk reward. And sometimes the only winning move is not to play. And I got that line from the 1983 film War Games, starring Matthew Broderick and Ali Sheedy, where they inadvertently stumble into a game called Global Thermonuclear War. And the computer that was running the game finally determines, strange game, the only winning move is not to play. There are trades like that, and this was one of them. So here's what we reviewed: a gap down and keep going, gap down and trap. Look at the framing and potential trade on the daily time frame. Risk is first, then is there enough reward to justify taking that risk? And in this case, that was irrelevant. So if you find this valuable, take a moment to like and subscribe. And as my buddy HONU always says, small losers win.